the US government, the way that we set up our tax system is basically kind. It's basically trying not to let you get into that ugly situation where you owe a bunch of money that you can't pay, right? So what we do for people like us who earn our money without withholding is we require them to have check-in points through the year to basically break up that full annual tax bill into 4 parts.
Welcome to the Sunlight Podcast. In this show, we're talking about taxes, money, and careers for creative people who have a big vision for changing the world with their work. I'm your host, Hannah Cole, artist, tax pro, and the founder of Sunlight Tax. If you're an artist, designer, or creative entrepreneur who wants to grow your business sustainably, manage your taxes, and build a stash of fuck you money so you can control your own time and have a bigger impact with your work, you are in the right place.
Hello. Today, I want to talk to you about breaking down estimated quarterly taxes. This was actually submitted to me by a listener of the Sunlight Podcast, Staley. Thank you. It's so funny to me because as soon as she suggested it, I was thinking I give talks to all kinds of different organizations, professional development organizations, design groups, networking groups, and art schools, design schools. And part of my talk that I give this talk that I give is about teaching the basics of taxes. And one of the core components of this talk is estimated quarterly taxes. So the funny thing is that I feel like I talk about this all the time. And when a listener approached me and was like, could you break this down? I was like, oh my God, yes, of course. How have I not done that on the podcast before? Anyway, this is a good lesson for me. It isn't always obvious to me what you, the listener, really want to hear here. And so let me just take a second here to say, I love hearing from you. If you want to send me a DM on Instagram at Sunlight Tax, because there's something you want to hear me break down on the podcast, please tell me. I love it so much. I've gotten about 3 requests like that in the last week or so, and all 3 of them made it onto my content calendar because all of them were really excellent suggestions. So just know I read them all. We discuss them in our weekly meetings here about which ones to go forward with. And so far, I've done every single one that's been requested. So I'm listening to you. If you want me to talk about something, let me know. All right, so today, estimated quarterly taxes. I'm going to break down basically what they are and how to know if they apply to you, okay? So here's what estimated quarterly taxes are. Our system, our US tax system, is what we call a pay-as-you-go tax system. What does that mean? That actually means that if you think about the way that we set up taxes in our society, we could have set it up anyway. So why did we do it the way we did? We could set up our tax system to be one where you're allowed to just accumulate all your income for the year with no taxes withheld. And then only at the end of the year, when it comes to tax filing time, do you get a bill from the government, from the IRS that says, here's your full annual tax bill, right? And you, at that moment, have to write them a check or get online and make a payment for that full amount, whatever that is, $20,000 at one pop, right? Well, think about that, how that feels in your gut, right? If you were to just get a $20,000 bill today from the IRS, how would that be for you? Most of you probably have a pretty panicky response, right? And that's legit. We know that. Who wants a $20,000 bill or an $80,000 bill or $5,000, whatever it is? It's proportional to your income, of course. So the government's not stupid. We don't set up our taxes like that because we don't want people in a situation where they're faced with a tax bill they can't pay. That really matters, right? Why? Because we want to actually collect the taxes people owe. It's not just a theoretical number to make people in the government feel a certain way. It's legitimately to pave our roads. There's real country to run, right? Okay, so pay-as-you-go system is what we have on purpose. And in fact, this is a tax principle that exists almost everywhere in the tax code, that we tax taxpayers at the moment they have the cash in hand. That is a pretty standard way of doing it. And if you think about it, it's just more fair and it's more logical, right? We don't tax you when your investment gains go up on paper, but you haven't sold them because you don't have access to the money at that moment, right? It doesn't make any sense to tax you when you don't have access to your money. We tax capital gains. I'm just giving an example of this system. We tax you when you have the money. You owe capital gains when you sell, when you actually have gains that are realized. Realized as a tax term. That means you've got them in your hand, basically. So when you get your money in the hand, that's the moment that the taxes will come. Okay, you can take that one to the bank with you. So in situations where it is possible to have withholding of your income as you earn it, it is going to be mandated that you have withholding, tax withholding, to cover your income taxes on that income, okay? So the big example here is employees. If you're an employee and you earn your money and your employer pays you on payroll, you're getting a regular paycheck, whether it's weekly, biweekly, monthly, whatever. So you're getting a regular paycheck and you don't have any option but to have some portion of your taxes withheld with every single check you get. Okay, so when it comes to part of your taxes that you'll see coming out of each paycheck, what's coming out of that? We've got your Medicare and Social Security. So from your own money, that's 7.65% of your pay getting taken out every single pay period and sent to the US Treasury to go to your Medicare and Social Security. And then your employer, this you don't see on payroll because it's not your money, it's your employer's money. 7.65% is being matched by your employer and sent more or less to your account for Social Security and Medicare to the US Treasury. Okay, that's mandated. They don't have any choice. When you hire an employee, you need to do that. That is the law. So Medicare and Social Security is being taken out of your paycheck and your employer is contributing on their side as well. And out of your paycheck, you also have income tax coming out, right? So the rates there are somewhere between 0 and 37%. Those are the full range of income tax rates. And that's what's going to the federal government. Now there's also state government. And so if you're in a state, and most of them have income tax, then you're also having state income tax withheld as well. There's also a couple little things on the state level that you may have withheld when you're with an employee as well. Like if your state mandates a disability payment, you might have a very small contribution going to that. The employer is dealing with unemployment tax insurance as well. So there's a couple little things, but generally the state level is pretty simple and pretty low. Also remember, there's no self-employment tax at the state level. Medicare and Social Security is a federal program. And so that's only coming out of your federal, that's coming, going to the US Treasury, going to the IRS. At the state level, there's no Medicare and Social Security. Okay, so the state withholding from your paycheck is much more simple. It's generally, the bulk of it is just that income tax, state income tax. And of course, if you live in one of the no tax states like, Florida, Alaska, Texas, there's a couple more, then you don't have a state income tax. So it's only the federal stuff. Okay, so that's what's happening in the pay-as-you-go system when you're an employee, right? When you have payroll and money's being taken out of your paychecks. And so what that means is you are more or less caught up on your taxes, at least the taxes you owe for that job, for that income, all year long. Okay. Now, of course, you're not going to be precisely caught up. We are able to calculate the correct amount of money that's going into your Medicare and Social Security because that's a flat rate that's constant, that is the same for every single worker at that company. So that one usually is accurate. However, your income tax rate, that's based on everything in your whole tax picture. And so it's very possible to get that number wrong, right? So, your income tax rate, yes, one factor in your income tax rate is going to be how much pay you earn at that job. But there's other factors, right? That rate is based on your whole income, everything. Okay. So what that means is what your spouse earns. If you're married filing jointly, you're going to have one single tax rate together as a unit. If you have other sources of income, a farm, a fishery, self-employment, all that stuff is going to factor into an overall income tax rate. So your employer can't exactly know what your income tax rate is, and you aren't obligated to tell them, hey, I'm like working on a side hustle, nights and weekends. Hey, my spouse earns like tons and tons of money or very little, or I've got all these dependents I'm supporting. You're not required to disclose those things specifically to your employer. What you are required to disclose is the level of withholding you want. So that's basically, you fill out a form called a W-4. And on that form, you indicate what type of withholding you want. Basically, I want a whole lot, I want a medium amount, I want kind of a low amount, right? It's not a super precise tool. It's about that accurate. But that's what the W-4 is. And the W-4 goes to your W-2 to tell your employer what level of withholding is appropriate for your paychecks. And they have to honor it. Okay. All right. So that's the W-4. That's pay as you go when you're an employee. You're mostly caught up, basically, with your taxes when you're an employee. And all you have to do is when you file a tax return, you're going to catch up on all the other stuff. So there's still going to be other factors that might raise and lower your actual taxes owed for the year. And so what you've had withheld through your paycheck versus what you actually owe once you do the calculation of all the tax credits you got during the year, or any dependents you had, or any other circumstances. And so you still, even if you have that nice situation where your taxes are more or less handled all year because you're just earning your money mostly through payroll, you still have to reconcile by filing a tax return and reporting basically the actual versus the owed, right? How much I actually paid through the year and how much I owed. And these numbers rarely match, right? And this is why most of us either get a refund for the year or we owe a little bit, right? That's because the number is imperfect, right? We're rarely hitting it exactly on the mark. And that's completely fine. There's nothing wrong with that. That's pretty much expected. Okay. So that's what it's like when you live in the world of an employee. But when you're self-employed, and if you're listening to this podcast, you are. So when you're self-employed, you're not being paid on payroll, right? You earn your own income. You're billing clients, you are getting big contracts, you are living off of large grants, you are making sales of products, crafts, art, selling tickets for performances, whatever it is, however you earn your income, you are earning it on your own. When that is the case, you don't have any withholding. There is no Medicare and Social Security coming out as your client pays you. They don't know what your tax rate is, so they can't withhold that. And how would they? They have no access to that information. And there really is no way for them to withhold any money, right? Let alone various clients who pay you do not have this set up. And can you imagine the headache of every single client you ever dealt with having to have some system to manage this? It's the nightmarishness of that is like incomprehensible. So you have nothing withheld when you're self-employed. So this is where estimated quarterly taxes comes in, okay? We have a system for us, for people like us who earn income where there is no withholding. We have a way to pay as we go, to pay taxes as we go. Because remember, what's the alternative to that? The alternative is gathering up all your income for the year, those client payments, those sales of your product or service, gathering up all that income, which has had no taxes withheld whatsoever, and then being faced on April 15th with a full annual tax bill, right? That $20,000 bill, that $80,000 bill, it's proportional to your income, so whatever amount. But yikes, right? Who wants to face a bill that enormous, right? And if you're not pretty on top of what your numbers are through the year and you didn't know what the number was going to be, maybe you've spent some of it. Maybe you don't have it in the bank anymore, right? So the fact that you had the money and you owed the tax doesn't necessarily mean you remembered to set the money aside, though we hope you do as you get more and more tax education. The US government, the way that we set up our tax system is basically kind. It's basically trying not to let you get into that ugly situation where you owe a bunch of money that you can't pay, right? So what we do for people like us who earn our money without withholding is we require them to have check-in points through the year to basically break up that full annual tax bill into 4 parts. Okay. So we pay a quarter of the bill 4 times throughout the year leading up to April 15th. And then when we file our annual tax return, there's only one. Don't worry, you don't have to file taxes 4 times a year. No, just make 4 payments. At the annual tax filing, like everybody else, you file your taxes, you do your tax return, and you reconcile. What did I actually pay in throughout this year in quarterly installments for, prepay in taxes? And then what is the amount that I actually owe? And how do these 2 amounts match? Did I undershoot it? Did I overshoot it? If you undershoot it, you'll get a little bill for the difference. If you overshoot it, you will get a refund. Okay. So that's how the system is meant to work. Now, how do estimated quarterly taxes work? All right. Well, first of all, I want you to understand that estimated quarterly taxes, that system of quarterly tax payments, it exists not just for us, not just for freelancers and self-employed people. Estimated quarterly taxes is a system that actually exists for all US taxpayers who have income coming in that doesn't have withholding. So actually, the group of people who this applies to is much larger than just us, than just business owners. Estimated quarterly taxes actually apply to farmers, to fisher people. They apply to people in real estate. If you're selling buildings, there's no withholding when you sell a building. So real estate professionals, on and on. Could be tons of different scenarios where you would have to pay your taxes quarterly. So how do you actually know if you need to be paying your taxes quarterly? All right, good question. The rule is pretty simple. If your tax bill last year was over $1,000, then you must pay quarterly taxes this year. Okay, that is the baseline. Now, why? Why is that true? Well, the reason is basically that's based on data. There is data that says the average US taxpayer faced with a bill over $1,000 would struggle to pay it, right? And so the point of this setup is to help you not struggle to pay your taxes, to break them up into smaller amounts that are more manageable for you to pay. So so that's why we set this threshold at $1,000. If you had a tax bill last year that was over $1,000, what is a tax bill? A tax bill is an unpaid balance that you had to settle up at the end of the year, right? So the point is we want you keeping that unpaid balance really small, tiny. Maybe we don't want you to have one even at all. We want you to overpay. So we're just giving you refunds, right? That would be even better. But we don't want your unpaid balance to go above $1,000 because once we have to send you a tax bill for over $1,000, we know your default rate is very likely going to be high, right? You might not be able to make that payment. And the whole point of a tax system is that the taxes actually do need to get paid. Okay. So that's why the threshold is set at $1,000. Okay. So where do we go from there? If you had that tax bill over $1,000, now what it means is you are mandated to break up your tax payments for this current year into 4 parts. And now you have 4 deadlines that are your new quarterly tax payment deadlines. What are they? Well, the first one is April 15th. These dates always shift a couple of days if that falls on a weekend, but basically they're April 15th. The second one is June 15th. The third one is September 15th. And the fourth one is January 15th. Here's a quick takeaway for you. If this applies to you, if you owe quarterly taxes, and there's a really good chance you do. If you're earning your income as a self-employed person, you basically do. I recommend putting these dates into your calendar. In fact, put a reminder two weeks before this, because it's really important that you do your bookkeeping before this date so you actually kind of know where you're at and know what you actually owe. Okay, so you want to put these dates into your calendar, you want to know they're coming, and you want to be sure that you make your payments. Okay, I want to give you a way to check and see if in fact you are in this boat of people who is in fact mandated to be paying your taxes quarterly. Okay, so I'm going to give you a little assignment, a little homework. I recommend you go pull out last year's tax return. When you pull out last year's tax return, you're going to see, one, you can see what your tax bill was for the year. Was it over $1,000? If so, you should be paying quarterly taxes. But even more crystal clear, if you look at last year's tax return and you see at the beginning of the tax return, before you even see the page that says 1040, you're going to see these pages that are blank at the top and just the last third of the page is filled in. It looks like that little kind of, when you send a bill, it's got a pre-printed address to the IRS. It might have a dollar amount in there. It has your name on it. That is called a voucher. That is a voucher for paying your estimated quarterly taxes. To the IRS, that is very clear, very clearly saying to you, not only do you owe estimated quarterly taxes, but this is the amount and this is where you send it. And you will see 4 of them on the front of your tax return. And you are meant to be paying those amounts on each of those 4 deadlines I just said to you. And you're meant to be mailing those in every quarter. So that is a crystal clear signal to you that you owe quarterly taxes. And in fact, you can look at that voucher to see the amount that was calculated for you by your accountant or your software last year that you're supposed to be paying this year. So yes, that is real. If you see those, you really do need to be doing it. So there you go. That's how you know that you actually definitely do need to be estimated quarterly taxes. I'm going to leave it there for now. And next week, we are going to talk about how you actually calculate your estimated quarterly taxes. How do you manage this? Because it's a little bit complicated. And I know when you first start paying quarterly taxes, it's hard to even comprehend that it really does apply to you, though it does. And if you're self-employed, I'm telling you, it really definitely does. But it's hard to get your head around how to actually make the payment. And I really want to address for you the idea of letting go of your perfectionism here, because in fact, the word estimate is right in the title. This is actually not a number that you can just get. You're not going to nail the number. You're not going to get the exact right dollar amount. Remember how I was talking about people with the W-2 still having to file a tax return, still having to reconcile, even though we know that their tax payments through the year were pretty accurate, right? So think of how that translates to us in the world of self-employment, where we have a lot more room for error and a lot more room for jumpy income, where the income might be really high one year, really low another, and we have quite a bit less predictability about what amounts we'll be making the next year. That makes our estimated quarterly taxes more difficult to calculate than it would be for an employee who doesn't have to do it in the first place because they have withholding on their W-2. So we'll get into how you actually calculate those payments. And I'm going to give you some mindset coaching here because I think that's really important, because what I see among my clients is that people get really scared. Okay. So I want to help you take the fear out of this process. It takes some getting used to. As Brene Brown would say, if it is your fucking first time, it's going to feel hard and weird. And then it will just get better each time you do it. Okay, so I'm going to leave it here for today and tune in next week for part 2 of how to calculate your estimated quarterly taxes. Thanks so much for joining me, y'all. Oh, and real quick, I am offering another one of my free trainings. If you are, even just wanting to come and feel the vibe of positivity and tax education and get some key takeaways about mistakes that self-employed people like you that I see making with their taxes, come and learn about that. My program is called Understand Your Taxes and Make Money. It's really positive. It's all about saying you can do this. I'm going to be talking about my story of how I kind of got to where I am and many really awful mistakes I made along the way. And I will be teaching you the framework that I use inside my program. And it is the exact framework that you can use right now to get on top of your taxes, to set up your fuck you money. So if you want to join me in that free class, I'm going to be offering the class on February 15th at noon East Coast time. You can register at go.sunlighttax.com/free. The class is going to be great. It's going to be high energy. It's going to inspire you to get those taxes done and get on top of your money so you can have more power in the world. It'll be great. So go.sunlighttax.com/free. I hope you will join me in that class. And I will see you next week for part 2 of estimated quarterly taxes. All right. Thanks, y'all. Bye-bye.
Thank you for listening. If you like the show, be sure to subscribe, leave a review. It really helps, and share it with a friend. I'm so grateful. This podcast is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links we reference at sunlighttax.com/podcast.